Great. Welcome, everybody. We're going to let you get situated for a second and start with the intros and get right into it. We are recording this session today and we'll send this out when we're done. We also would love today to be interactive. We don't really have a preordained profile for how we're going to roll here. Just to get started, we'll give you a market overview and some intros and data, but please, if you have questions, go ahead and put those in the chat, and we're monitoring that so that we can address whatever your questions are or elaborate on whatever topics we are discussing. Great. Well, I'm J.Thelander, founder and CEO of J.Thelander Consulting, and I'd like to introduce Robert, who is at Kaufman and Rosen, who is my esteemed colleague here on today's panel. Robert, thanks for joining us. Why don't you fill us in a little bit about who you are and what you all do?
Thank you so much, Jody. Really appreciate it. As you mentioned, my name is Robert Alonso. I'm a managing director here at Kaufman Rawson. Kaufman Rawson is a group of firms, primarily one of a 65-year CPA firm. I run the fund administration group along with some of my other partners. Been doing this for 25 years in the industry now, servicing a little over $30 billion in assets across 75 different client groups and 300 funds, ranging from closed-end private equity funds to open-ended hedge funds, issuing daily, quarterly, weekly, monthly NAVs. I'll hand it over to Patrick so he can make some introductions. We can get to know him as well.
Yeah, sure. Thanks a lot, Robert. My name's Patrick Casson. I'm at Greenberg Traurig. We're a large global full-service law firm with over 2,800 attorneys. My focus is on private funds and regulation of private fund managers. So fund formation work, also represent LPs going into funds, and then the interactions that our clients might have with regulators as well. And very excited to be here today and get to know all of you. Jody?
Great. Well, thank you. So the reason we're all here is that there's obviously lots of components regarding investment firms and the compensation and the fund structures, and there are best practices around administration and the allocation of carried interest. I'm going to start. We've here at Thelander have had a 10-year partnership with PitchBook. So PitchBook clients get access to a subset of the Thelander platform as part of their PitchBook subscription. And also we get to be able to leverage some of their data. So PitchBook published in September a global private market fundraising report. And I think it's a really relevant way to talk about, it's so funny, someone keeps popping in from Kaufman. You might want to go off that link. Thank you. Robert, I don't know. Did you send this out firm-wide saying that's the second time it's happened? Kaufman and Ross, and really, we have people who really want to get on this webinar. Okay, well, we're just going to let
They're very interested.
I could be very interested. They want to show up. Okay. All right. Back to the PitchBook report. This is the fun about being live, right? Never know. Okay. So VC fundraising totaled just about $50 billion across 536 funds for the first half of 2025. And it's really the market's increasing concentration is notable because the 10 largest funds accounted for almost 26% of the total commitments. And that's up sharply from about 17% in 2024 and 8.6% in 2021. So we know this, right? That there's less firms getting more of the money, but much of the capital has been secured by a small cohort of brand name managers, while the broader market has been facing constrained LP availability and tighter allocation budgets. So we know this. In addition, in the current environment, GPs are slowing deployment to preserve reserves for follow-on investments, particularly in the more portfolio companies are requiring bridge money and they're trying to extend their cash runways. And it's kept many managers from launching new flagship vehicles. And those that have entered the market are often leaving funds open longer to accumulate more commitments. And so, this is probably impacting. So it's much of the capital that's been raised by first-time funds in the US came from teams spun out of established firms, right? Leveraging their prior networks, or in some cases, people who have been successful as entrepreneurs who are starting family offices or investing their capital. So it is definitely causing challenges with LPs and also looking at the compensation investing times for carried interest. So I'm going to get into a little bit of data here. So we here, Thelander, we've been in business for 30 years. I can attest to that because I founded the company. And we have had a nice run of data being used in all the usual places. As I said, PitchBook's been our data partner, but we've got Axios, Forbes, Fortune, all over the place. And the data is real time. As Morgan on my team said, she pulled the data yesterday for quite a bit of what we're going to be covering today. We hope you take a look at Caplander, our podcast, because that's been really fun too. Okay, so by way of background, we look at different types of firms. So it's not just venture or private equity, but you can see VC as a part of it. And I know we've got some real estate folks on today, family office, and the value of the assets under management. And Patrick, I'm going to turn this to you for a second. When we look at comp data almost consistently, regardless of what type of fund it is, we see that assets under management really has the largest impact. What are your thoughts on that? And you can also see that 7 billion plus, I mean, funds are like true to what we just heard from the PitchBook data. Firms are raising more capital.
Yeah, I mean, I think at the lower end of the scale, people are taking more career risks. So I think you have to try to share more. And the terms, we're going to get in a little bit later, maybe to the terms of carry grants and sort of what you have to give away to employees and your partners. If you're a founder of a firm, I think that's a little more favorable to them in general at the lower end. But given the size of the pie, the availability for current cash comps obviously lower in most cases.
Yeah. Here is another picture just by way of background. So our data is global. As you can see, about 85% of it is in the United States. But then we really cover all over the world and there are different comp structures and different formations around how these firms are put together. And then within the US, we've moved a lot away from just being this Bay Area centric or only New York centric. Really there are firms all over the US. And again, we don't see a lot of variation by geographic location in terms of how funds are put together or compensation, but it is really dictated by more the investment strategy or the assets under management. And then here's the data within Europe. We do see a distinction US versus Europe based in terms of location, but we'll get into that in a little bit. The last area is sort of oversight in terms of our comp data. So we have a give to get model. You're sort of asking yourself, well, why do people give us this data? And it's because if everyone who participates gets the very data that they gave us back, meaning if you answer and fill in comp data for 10 jobs, you get those 10 jobs back. And that's really helpful. So you can see also that there are so many jobs now. I mean, Robert, this has probably changed in your lifetime being at the firm. There are so many, VP level, chief level, director level, manager level. There's many more people who are involved in these firms.
Yeah, there's no doubt. You're getting more specialized positions based on the needs of the individual company, and it also depends on the size and where they are in their own evolution, right? You're still dealing at the investment management company level. You're still dealing with very, slim, bare bones folks when they're just getting off, and that continues to elaborate or just gets more complex as you get more vintages under your belt, as you get more structure and infrastructure needs grow. So working with a group that could basically support your entire staff and support everything that everyone needs from a data perspective, from a reporting perspective is critical so that when you
Right.
are in a small group at the onset, you're presenting as a much larger organization.
Right, because here is a slide on that actually about how many funds are currently being managed. And this really does go to the infrastructure of how many people you have in the investment team versus the back office. Yeah, Patrick, I see you shaking your head yes on that, right? Because if you have multiple funds, and here is the how many funds are currently being managed by total AUM. And you can see, obviously, you get into when you're at the higher asset classes, then you have more funds being managed. Patrick, how does that impact how the structure goes?
Yeah, I mean, it's funny you're saying that because I'm just dealing with this issue today with more of an emerging client. who's fortunate enough to have won commitments from a number of large investors, but the reporting
Right.
requirements continue to grow. And it's interesting to try to have a conversation that's focused on where, we have 5 people. Do you really need all of this? The answer is usually yes. And I think that's just the challenge that groups have that are getting going. The advice I give to clients is there are a lot of people more on a consulting basis who can help with this, and in a lot of cases it can be a fund expense as well. So I think that's kind of the way to handle if you're in
Because
this.
it changes, right? The way you set up your first fund may change how you set up your second or third or fourth fund because there's so much more capital in there. Barbara, you're also shaking your head on this. So why don't you two explain what kind of advice you give to someone who's now raising a second or third or fourth fund because it's changing from how they did their initial.
Yeah, to Patrick's point, I'm a strong believer, and a lot of folks in the industry are strong believers of outsourcing as much as you possibly can because you don't want to necessarily expend that cost of building that infrastructure to support the reporting needs and all the other things that you're going to need as a manager, right? So making sure that you develop a good relationship and choose the right person to work with on the long term, not necessarily taking a short term, cost effective view.
Right.
My experience has typically been if you're looking at that kind of time horizon, it's going to end up costing a little bit more in the long run. So making sure you're working with the right partner that can grow with you and that you're not going to outgrow is critical, right? And working with a group that can solve more than one of your pain points is also very important, right? Having that depth and that deep bench of resources that you can tap into to deal with any of your business needs, right? Whether it's at the GP level or the IM level or even the fund level, is very important to have.
Yeah. Patrick, any other thoughts on that?
No, I just underscore. I think, especially at this, the when you have fewer funds and smaller, you really need to rely on the outside managers if you're tapping into institutional investor sources because their their reporting requirements constantly change and they can be pretty rigid, as I'm sure everyone on the call knows.
Yeah, and you might even run into a situation where you're not necessarily thinking of any sort of registration or fall under the regulatory preview of any organization today, but as you continue to evolve and have different offerings, you might get into that. So you'll want a partner to be able to work with and guide you through those processes.
Yeah, because it's very important to not only think about where you are, but where you're headed.
That's right.
Let's talk a little bit about what the compensation levers are for investment firms, sort of categorically across the table, right? Maybe hedge fund a little bit different because they have a different on and off ramp. But in general, we look at cash compensation as a base salary. We track a current bonus, meaning it was paid, and then a target bonus, which means it's out on the horizon, typically for the year, because that's the short term incentive versus the carried interest. And then you get to total cash, which can be a mix of base pay and an actual bonus, or in some cases, firms don't have a bonus structure and it's just the base pay. I'm sure all that seems pretty straightforward. And then the different other incentive vehicles, which are carried interest, carry dollars at work, and then and often we see in addition to that, you can have an equity distribution. Patrick, anything you want to break down around the carried interest, carry dollars at work, or equity distribution? Are you seeing equity distribution very much?
Yeah, I mean, it depends on your fund structure. I think we were going to also talk about American versus European waterfalls.
Yeah.
So, um, yeah, maybe I'll just say a little bit about that. I'm sure most people on the call know the difference, but in a European waterfall, the investors have to receive a return of all of their capital first, and then the preferred return, and then after that, there's carry sharing that happens. In American waterfall, it can be deal by deal, or it is deal
Right.
by deal. So each individual deal, you earn the return on it, and then you can earn carry if that individual deal does very well um, throughout the life of the fund, potentially, and definitely at the end of the life of the fund, there will be a clawback unless you're one of very few firms that actually don't have clawbacks. But almost everybody has a clawback who has an American waterfall, and that means that if some of the investments paid carry and others did not, there'll be a true up at the end effectively. And so, to the extent you're one of the firms that has an American waterfall, I'd say in general, you know, the firms that have been around for the longest tend to be more frequently have them because that was more common when they started. Much, much harder to get it as a newer firm now. And then firms who have just been, that top decile consistently, I think can also pretty usually can get an American
Yeah, because a
waterfall.
clawback is not a fun thing to have to experience.
It's not, and that's what I was going to say. I mean, basically, all of these things are a function of that waterfall. So you have an American waterfall, you can, of course, give more cash distributions along the way to employees. But to your point, as if you're the founder or the senior people at the firm, you do need to think about the clawback if you are handing it out because the fund, you may have to return that those proceeds to the fund if there's a clawback.
Let's back into this way, and then Robert, you jump in here. So that for just the fundamental 101, I apologize if this is such basic information for all of you on the webinar here, but the total amount of carried interest for the firm, the tradition is an 80-20 split. And maybe Robert, you want to talk about what you all do and how you're looking at the fund administration and the allocation of that carry. So to distinguish, our expertise over at Thelander is to describe to you the total amount of carried interest for the firm, the vesting times, which we'll get into, and the allocation of that carry. And then, Robert, you on your side of the house are part and parcel with us getting the numbers right, then explain a little bit more about the execution of that.
Yeah. So as the funds administrator, we're providing the official books and records of the fund. So we're recording all of the activity that's happening in the entity, making sure that we're calculating the proper P&Ls and recording the proper valuation adjustments. All of that, maintaining those books and records, making sure that we have the proper support, goes into the allocations that are allocated to the investors, whether it's an American or a European waterfall.
Right.
What we're doing is based on those terms of the waterfall, calculating what portion of the P&L should be attributed to what aspect of the waterfall. Patrick alluded to a return of capital as 100%, so 100% of that capital goes to the investors first until they've reached their return of capital. Then there may be a preferred return mechanism where they're earning a guaranteed return before the general partner is allocated any portion of a carried interest calculation. There's usually a catch up in order to true up the
Right. So once you reach that threshold, then
Mhm.
there can be, that's how we look at it too. Then there's a catch up. You get what you would have gotten. And
You get what you would have gotten had that in order for that LP to make that preferred return, and then you get that 80-20 split. There are different mechanisms and different structures of waterfalls depending on the strategy of the fund. VC funds and PE funds usually have a straight 80-20 split with no preferred mechanism in there, whereas a real estate fund might have this traditional and then some variations in there as well to accommodate, recurring ordinary income that's being generated from cash flows versus capital events. But that's
right,
that's getting into the weeds.
the tax component. So Patrick, if a fund is starting out, what's the difference between the first fund or the second and third, right? How does the carry change? Or how does the setup, the fund structure change?
Yeah, I mean, it's definitely easier, and you alluded to the fundraising environment. It's definitely easier to go out with the European waterfall, but there are some asset classes where an American waterfall would be more common. So it's always a debate, I think, with clients who are starting out. Do they want to give it away? Because once you give it away, it's very hard to go back.
I mean, once you give the carried interest away,
Once you go to the European waterfall, it's hard to come back to that same group of LPs. Now, some
right?
people will say, a common thing is they start more with high net worths and then they sort of relaunch as an institutional fund manager and then you could change your documents at that point and try to get an American waterfall if you're in the
Right.
type.
So our data show that 72% of the firms who have a waterfall, it's European.
Yeah. So, and I think I for what it's worth, it's always worry. You have great data, which is great. Lawyers are a little less. We have small sample sizes, but my sample size is similar to that. And in this current environment, I am seeing people, including pursuing strategies where you probably could have a better argument to get American waterfall, that they're going with the European just to take it off the table. I do hear from investors also, thank you for starting with that. I think it's a good it definitely wins points with investors.
Let's talk about the vesting times because there's been some change that we've seen here. So the 80-20 split 80% of the money is coming from the LPs, 20% of the GPs, and then the allocation of that 20% is what we get into in terms of who gets what and whether there's a capital contribution for that percentage of your carry. But what we're also seeing vesting times, and this really goes to the levity of what's happening in the market, and that liquidity is taking longer. And so as a result of it, we're seeing that the largest growth, and talk about sample sizes. I love that you said that, Patrick, because no one's more surprised than I am at how many firms give us their data now. Like in the beginning, when I first started these surveys, it was like a log jam of, okay, one firm, two firms, and then we hit critical mass of like 500 firms. And then when PitchBook and I teamed up 10 years ago, then we immediately went from like 500 to 1,000. And now we have thousands of firms across all types of firms. And it's great because while we may already know the answers, the sample sizes really give everybody more confidence. And you can see just the number of firms that are giving us the data now, 637 in terms of the vesting times, and the 10-year plus is moving to be more prevalent, and that 4 to 5 years is on the downward spiral. Is that what you're seeing when you're setting funds up?
Yeah, yeah, absolutely. I think 5 years used to be the sort of what everyone
Right.
did, and now, at least with the longer hold strategies, and yeah, it's sort of moving. The other thing you that maybe doesn't come through in the data is what exactly are the terms of the vesting. So there's some firms where if you vest, it's yours unless you commit a crime or do something really awful.
Right.
You leave with it. I think it's a lot
Right.
becoming
That's
more
actually a
common.
great, I'd love to, let's talk about this.
Sure.
Here's some data that we have. We do have that other information, but we're talking about, first of all, is it equal each year or does it change over time? And you probably see this on a firm to firm basis, but, and Robert, you probably track this, right, in terms of how it gets distributed.
Yeah, if we're doing the allocations and doing the work at the investment management level company or the GP level entity, the majority of the work that we do is at the fund level where we're doing that allocation from the LPs to the GP. But if we are doing the work for the GP, then we are getting into some of this information as well.
Right. So you're distributing the whole 20%.
Correct.
Right. So Patrick, how much are you seeing that when it's being set up, that people are smart enough to negotiate how, is this done in an employment agreement or is this done just in terms of the fund structure to figure out, like, do you have to be present to win? I mean, I know a lot of my colleagues in the venture side who have helped with the very questions for this, that they're up against these sort of handcuffs that if they leave, they're not taking it with them.
Correct. Yeah, that's what
That's
I was
why
going
they're
to get to.
there.
That's what I was going to get to. That's or it puts the firm sort of in the driver's seat if there's a conversation about a departure because they do leave with nothing, even if it's they've done nothing wrong. And that yeah,
Right.
that's a growing trend. I'd say that's much more common. It's typically, to answer your earlier question, in the actual grant document. So so yeah, and the grant documents evolve. I think in some ways that's a good approach because you can continue to evolve your approach as time goes on. And it does seem to go like all these trends. I think it favors the larger firms and then the firm over the investment professional. That's
Well,
what
the
I
problem is, this is the problem. I'm going to share this slide. This is the problem, is that the percentage of committed capital that people have to contribute for their carried interest, right? So this is for the GPs overall. So you got to contribute capital, and these capital calls keep coming from what we're seeing on projects, despite the fact that the vesting times are taking longer. And even if you're fully vested, there's not necessarily a return. And also, the IPO and the M&A markets, and many times you have to return the whole fund before there's any distribution. So Robert, you're shaking your head. What's happening on from your purview with this?
Yeah, so you're seeing longer time horizons for the GP to actually be into the carry once they've met those thresholds of distributing back the return of capital, the preferred return. So a lot of times you might have on a gap basis an accrual for the carried interest, but that doesn't mean cash in the GP's pockets, right? Not until there's a distribution or realization event where they've actually sold an asset, returned that capital back, met the preferred return and can actually
Right.
start generating some cash flow. So that might be, unless you hit a very sizable home run, that could be 4, 5, 7 years into the life of the fund before you start getting cash back.
Right. And that's why also we're seeing that there are some of those equity distribution where you have to squeeze out from a success of a portfolio company to give some kind of almost equity distribution, like what the private company, what the investment gets, so that you keep people engaged, because otherwise it's getting to be a really long time.
Mhm.
And then let's talk about, then we'll get into some of the comp data, but this is where I'm sure also, Robert, this is your expertise, and Patrick, but explain to us the management fees as a percentage of the committed capital and how you obviously must track this.
Yeah, so at the fund level, we are tracking this, and Patrick, I guess he can speak a little bit more to this, where the industry has coalesced into a more standard structure where during the commitment period of a fund's life cycle, investment management fees are a percentage of the committed assets, and then after that commitment period, that basis of the calculation changes to what has actually been deployed, right? Invested capital. So I think we might have lost Patrick.
We lost Patrick. Maybe one of your people could step back in
Yeah,
now.
maybe they can. Maybe they can jump in. But
I
yeah,
think he'll be back.
I'm sure yeah. So the industry seems to have coalesced into that sort of structure where the manager is focusing primarily on the deployment of the entirety of the commitment. After the commitment, they're no longer raising capital. Now they're getting paid for what has actually been deployed, what's actually been invested until it's been recovered.
Yeah, listen, let's get into exactly what you're talking about, because people obviously care about the compensation as well. So you can see that in our surveys and our data, we cover everything. So that's the nice part, is that we only have private market and private capital. We cover the private capital market. So our resources are for the investment firms, and we try and cover everything, not just on the comp data, but the other components of how a firm is structured. But it's only as good then as the administration and someone like Patrick. Glad to see you, but you made it back with us, Patrick. We had faith in you about how to set the fund up, and then additional funds, because it's different over time and more assets under management, and taking into consideration what's happening with the market and the LP and GP structure. So a lot of firms now, you can see only 60% have a formal comp structure, and only 40 people answered this, right? Because nobody generally has really thought of this whole venture and private equity and real estate as a career. These have always been sort of industries. So that's a new question. We're asking this because we know these are real career tracks, and we're trying to put in infrastructure around this. So we know we have a lot of CFOs on, so we thought we'd give you a bone here. And we have a lot of information that shows year over year. So this is across all firms, median total cash and carried interest year over year. And don't get excited if some CFO is looking at this and says, those numbers are so low. This is median. We also have 75th, and then we have max numbers, which are very real numbers. But really, this is just going to the stability of the marketplace, and then also the carried interest percentages. So we hit a little bit of a peak. I know, Patrick, did you see that in 2022, when things were really aggressive in terms of the carry went up a little bit? It sounds like, Robert, you're shaking your head yes.
I'll let Patrick answer this one.
Yeah, I mean, I think that was a great time, yeah, to be
Yeah.
out there. Yeah, as an employee for sure.
Yeah, you had more leverage. And then here is, we're showing, okay, this is hopefully makes everybody a little bit happier because these numbers are nice and bossy. So this is for a managing general partner venture, although we don't see big differences when you start to get into the larger asset classes, because then a lot of the VC funds have also the crossover funds, which could be a little bit interpreted as private equity, but you see the median, 75th, and max numbers. And this is where we talked about the different comp levers of base pay and actual bonus getting to total cash, because it's not a straight addition of base pay plus actual bonus, because the sample sizes aren't the same, and not everyone's total cash includes a bonus. It could just be their base pay, but you can see that these numbers are pretty robust. And then the percentage of carried interest is 20%, 30%, 50%. And this is of the 80-20 split. So Robert, talk about fund administration and what happens with numbers like this. So you talk about the administration up on the whole of the GP, and this is the next breakdown from there.
Yeah, so what we're doing is at the fund level, calculating what that management fee is and what that carried is at the fund level, and then allocating it back. So more, obviously the larger stable of funds that a manager has, the more they're drawing from the investment management fees.
Because it could be rolling from multiple funds.
Absolutely. So there could be multiple vintages of funds that they have. There might be some
Right.
legacy stuff, and they're rolling out maybe a fund a year or every other year, which are generating that investment management. But then that leads to more infrastructure requirements, more, kind of circles back to what we were talking about at the onset,
Yeah.
working with the right partners down the road.
So what infrastructure, what has to be done, right? You raise your first fund and let's say that's maybe a 250 or $500 million fund. Then, and we know that your allocation, and Patrick, please feel free to jump in here. When you're setting that up, right, people probably have larger carried interest because it's of a smaller pie. But you can't keep going with those larger. I mean, we work on a lot of consulting projects where then we have to adjust if it's a second vintage or a third vintage of a fund because hopefully it's been so successful that you can't keep going with those high levels of carry. But how does it change from the administration and also just the structure of the fund?
Yeah, I mean, I think it somewhat depends on who your investors are. If you have large institutional investors, especially the government plans, then their bespoke reporting requirements are, they're a challenge. So it just sort of it goes up significantly from there. If you're only have high net worths, then that's pretty straightforward. That's not very hard usually to do
So there's
reporting.
no one size fits all.
Yeah, it's all very dependent. That's right.
Yeah, it's going to. My experience is that the investors, the LPs, are really driving the where your fee structure is going to go. In your first or second, they might want a bigger piece of the pie of the first fund. They'll taper off, as the additional vintages. And it's a little easier for you to raise some capital because now you have a bit of a track record.
Right.
But it really depends on who your LPs are.
Yeah.
Yeah, that gets in, Robert, to another theme, which I don't know if you wanted to talk about, Jody, but that's for earlier managers, the theme of LPs taking a piece of the carry, which I think is very prevalent right now, at least in my sample size.
Mhm.
So of that 20%, you could be giving away 20% to large LPs in the current
In
environment.
addition to what they've and the money that they've given, they also want some other component of it.
Yeah, they want to take a piece of your profits, basically. Yeah.
And how much leverage do the big funds probably have more ability to say no to that?
Yeah, I think it would, yeah, I don't think the big funds, it would be exceptional, but for smaller funds, for a $100 million commitment or even a $50 million commitment, they are giving away, a significant piece of their own carry. Now,
Yeah,
usually those investors don't also negotiate down the carry. Um, so they're paying carry and then they're receiving a percentage of the whole. They're net positive.
yeah.
Um, yeah, and then we on the legal side, we have to be that flows into the conversation on MFNs, and we have to be pretty strategic in the way we document things and think about that so that you're not opening yourself up to having to give carry to other investors who might join the fund.
Yeah, and I think some of that data that you were showing before, Jody, with regards to the compensation based on the asset levels is
Right.
speaking to what Patrick is saying. Smaller funds have a little bit harder of a time to raise capital, so they have to give up a little bit more in terms of their own compensation to be able to get that fund off the ground. Uh,
Yeah, I'm going to show a couple more data points because we know everybody cares about this because it also highlights what you're saying, right? So here's a director principal. Let's see. Here's a director principal with less than 500 million of total AUM, right? And obviously, this is a very important like job level because the director principal is sort of the inflection point. This is where if people don't start to get what they need or they want or they feel like it is competitive with what their skill set is and their contribution, they leave because the director principle is when you start to get in from to get into a more important part of an actual firm. So you can see the percentage of carried interest. The 4 to 5% is not a big difference between the median and the 75th percentile. Obviously, a percentage of carried interest could be a very meaningful difference, however, and the total cash compensation is also 225 to 270. So in somebody for $50,000 is a significant amount of money. And then here's a senior associate, right? The next level. And this is private equity versus venture for less than $1 billion of AUM. And you can see that private equity in general pays more because the less than $1 billion is the very small side of the PE versus, for some venture firms, the less than $1 billion is still a significant amount of assets under management. And then here is total cash as senior managing director. So that's the next level above that director principal. And this is for the UK, including the UK for Europe. No disrespect to the UK. We know we have separate UK data for quite a bit of some of these jobs, but not everybody. And you can see that the US on the max number is much higher than Europe. So that's what we're seeing. Even the medians are, the 75th percentiles are higher in the US, and the medians are pretty close, the US versus Europe. Do you see differences in setting up funds between the two, Patrick, globally?
Yeah. I mean, just transparently, my practice is more U.S. centered, but we definitely work with a lot of European clients. I think in Europe, the market's a little, in my opinion, bifurcated. There's some people on the U.S. model, and it looks and feels a lot more like the U.S. Although, in general, cash comp levels there are lower. I don't think
Yeah.
carry sharing levels are necessarily lower with those firms. Then
Yeah,
you have
here's
other
that.
groups.
Yeah,
Yeah,
here's that data for you. Actually, that's a great, love that you just teed this up for me. So here's the percentage of carry, right? And this is pretty consistent. So it's
right,
really the cash part.
right.
Why do
And
you
then
think that is?
um, mm,
Because
well,
they
I
still
think
are,
I think
it's
the
just a
carry
different
pie.
structure. Yeah.
Yeah, if you take the model that we're using here, and there's a carry pie that goes to the employees, that's sort of a given from on high. So I think that's why. But there are some groups in Europe that are doing investment management strategies, but it's just a totally different construct, more of an, I guess, employee model versus a
Yeah.
partner model. I think that's a little more prevalent there.
I'm going to show one more job because this job really shows the importance of how the funds are having to deal with their LPs. And Robert, it sounds like you're pretty knowledgeable on this as well. But the VP of Investor Relations, you can see this is the median total cash and carried interest. And we do have a higher level of investor relations as well. So, but you can see that the numbers are going up and the amount of carries going up. And so certain, especially because they're putting in the highest level of investor relations and then a VP and then a director and then a manager. So, and again, this is median, not 75th or max, because those 75th and max numbers are definitely more robust. But these are increasingly important jobs because the investor relations piece is really getting tricky. Yeah,
Yeah.
Robert's, yeah.
There's no doubt we work very closely with those folks on the investor relations side of our clients, and their demands for data and primarily service, being able to manage and provide high quality service to their investors. At the end of the day, it was a challenge to get them in the door to begin with, and now you want to keep them in there and you want to stay in there for the next vintages, and
Yeah, the
those guys are
consistency is
very
really important. Here's
consistent.
one last optics on this before we sort of, I want to be respectful of everyone's time since we're winding up in about 5 minutes. But you do see that with the higher asset classes, in general, the carry goes down and the total comp goes up. So this is a managing director slash partner. This is from our compensation planning tool. This is automated on our platform for subscribers. So you can project out to see what's going to happen by the larger AUM, so 50 to 99 million, 250. So you're from an emerging fund to the 250 to 500, 500 to a billion, and then we did the 2 billion plus. And so you can see as a trajectory. And I think that's a really important inflection point to know that the planning part, and this is sort of stopping where we started, is that it's really important for the planning piece of it because it is going to change over time, no question.
Yeah.
I'm going to show one last section here about the firm structure and promotion because it does really play into a little bit. And maybe, Patrick, this is more your area of talking about by assets under management, about the structure of where you are more partner intensive and when, and I'm Robert, you probably see this in the administration of what the GP, about the amount of money that's going to the GPs and the carried interest, but it really starts very high with a number of partners. And then at a certain point, like you were saying, you're going to have to fill in your organization and it's going to take more of the operations and the administration to balance things out. And this is the average. And then the firm headcount, you can see it moves into all these other areas and it's still more people, but it starts to level out. So with all of this, I mean, we could go on and on. We just had other great data. We had a question about sort of how firms are handling AI and venture, and that are we going to be, are these firms going to be able to replace people with different kinds of resources? So here's a snapshot of that: is how is your firm leveraging AI tools? and you can see that they're getting some intelligence and competitive intelligence and market analysis, due diligence. Can't really outsource deal sourcing, but general administrative in terms of writing and so on. It's not definitely not going to replace who the partners are, and they're getting things that are off the shelf and using Chat GPT. So just to make sure that we know that all firms are staying relevant. With that, we're going to ask each of you, Robert and Patrick, for your best practices. If anybody can have one takeaway from your years of doing this, what wisdom can you impart?
From my perspective, hiring the right partners, working with the right folks that are going to add value to your business, working with folks like Patrick, working with folks like us that are going to work together at the onset while you're forming the organization, the structure, thinking through what you're intending, how you want things to work, and leveraging the value that we're going to provide. I think that is critical, especially for your emerging managers.
Because the sooner you put it in, the better off you are. Even if it seems like a lot, it's never too early, is what I'm hearing you say.
It's also cheaper to do it now than later. Once the documents have been drafted, and doing an about face or making any kind of changes downstream can be very costly and disruptive to the LPs that you work so hard to get into the fund.
Yeah, so even with an emerging fund, it shows sophistication knowing this has to be put in place. And Patrick Greenberg, such a stalwart of this industry based in Miami, like we all are, which is nice. We sort of have the home team today, but an incredible firm reputation and your expertise. What we're lucky to even have you. I know your billable hour is probably a number that none of us can, we know the worth of it, but since we get your expertise now, what do you have to say to everyone here?
Yeah, I'd underscore what Robert said, and then I think you mentioned AI. AI is actually really helpful, so we can get more work done on the legal side, especially things that are um, the stuff that actually no one likes doing that's repetitive, and it's being helpful. It's helpful with that, but at the same time, I think when you're looking at advisors, finding people who can understand the people and the dynamics and have the substance is very important in this space. I love this industry. It's a lot of fun. It's still very entrepreneurial, even at the
Yeah.
very established firms. And we have to be nimble and keep changing. And the one thing we have to get right is managing that balance between protecting ourselves and sort of getting what we want, and also making sure the people around us are happy, our investors, our employees, and so forth. So that's the attitude we always bring to the transactions and situations we get involved in. And I think I think that's it's a good value to keep in mind.
Yeah, I mean, let's face it, the investment firms and real estate, it's all very innovative. It's an integral part of this ecosystem. It's not going anywhere. Conversely, only the strong are going to survive because you've got to have a game plan. You got to be equipped. You got to build that structure with a solid foundation from the beginning. And that's why you two firms and your expertise is imperative. And of course, we believe strongly that as part of that infrastructure, you've got to have the right comp strategy and planning tools, because if you set this up as though your firm is not going to have turnover and you're planning for career succession and how the firm is going to be structured, then it's never too early to put in compensation as well. And with that, I'm going to wind up. We are going to put in the link for the survey because, again, it's no cost to participate. You get back what you give. So there's no gotcha here. It's just really important that everyone has data to make good decisions. And thank you to Robert and Patrick for joining, and all of you. If you have questions, let us know, and we will send out a follow-up from here.